The game is on, guys. My only question to everyone is, have you got enough physical gold or silver? Do it, guys. Come and do it with us. Do it with them. Do it everywhere. Just get your silver. This is the Achilles heel.
Upon the breakout, gold's going to make a new all-time high.
Gold-backed ETFs seeing inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin.
All right, hey there, welcome to Live from the Vault. My name is Shane Morand, and I will be your host for this edition. And as you can imagine, the Kinesis community is growing very fast. I want to thank you so much, and keep spreading the word about this channel by liking, sharing, and subscribing. By the way, if you hit the bell on right down there, you can see it. You'll get notified as these episodes go live. So with that, let's head over to the UK for Talking Gold with Andrew Maguire. And it's hard to believe, Andy, that it's been 2 weeks since our last episode. And there's so much happening with all the volatility in gold and silver. So, Andy, let's start off this edition by maybe picking up the threads from our last episode 2 weeks ago.
Hey, great to be with you again, Shane. Nice to see you, my friend. Absolutely great, because that's exactly what I'm hearing myself. What's going on, and we've got a range of people who, we've got stackers, we've got people who are in for the long term, we've got people who are in on a short-term basis, people who can't afford to lose very much and really kind of want to know, is this the best time? Now, obviously, we're not offering any trading advice here, but we're just giving you our view and the wholesale market view. And really, because the trouble is, we're dealing with a COMEX marketplace, which was installed, as we know, we've discussed this before, 50 years ago for the sole purpose of injecting volatility and dilution into a market to basically control the price of gold and, of course, silver. So really, from the face of it, when we 2 weeks ago, really, it doesn't look like a lot's changed on the surface. But you know what? It's a bit like that duck swimming on the water. It looks really calm on top, but those legs are very, very busy, and so are ours. And in our last episode, we kind of drew attention to the counterintuitive, and this was the issue. Why is the price going down when there is such strong demand? And so we kind of looked at this overshoot of physical gold and silver support levels, which was so counterintuitive to the action, because we were also evidencing stealthy insider short covering, which is balanced against this fast closing Basell III window. Now, the short cover window for unallocated gold has now contracted, guys, to under 70 days. And in anticipation of this new regulation, banks do not want to be naked short gold, period. Look, there are still billions of dollars worth of unallocated gold positions to unwind before this 85% haircut makes it far too expensive for them to, or officials for that matter, to engage in gold lending or hypothecation. So whichever way you look at the Basell III, that is a factor. And while the general, and it's so good, I welcome skepticism, I welcome questions, well, yeah, but hang on, surely the general understanding is that officials, headed of course by Benoit Gilson's BIS gold desk in Basel, Switzerland, but they hate gold, and surely they want to continue to suppress gold prices forever. Well, in reality, really, Basell III changes this stance because defending the growing threat to US dollar hegemony is actually the issue here. It's far, far more important. It supersedes everything. And it just means changing tack. Now, as we've discussed previously, the accrued toll of having suppressed gold 50 years, basically, by adding undeliverable supply into really what is an increasingly strong global physical market. What that's done is create this untenable condition for the Bank of International Settlements, which heads up, obviously acts on behalf of the Fed and other officials. Now, So with rapidly dwindling physical supply backing up this accrued, highly leveraged paper gold position, which has built over multiple years, each ton of competing central bank and sovereign physical demand really that leaves the LBMA's flywheel. Let's just call it a flywheel. What it does is it slips the price suppression control out of the Bank of International Settlements' hands. Now, in a moment, we're going to look at how China has now raised the stake on this last week. But you know, really, there are clues in there. But the very fact that the BIS has resorted to swapping and leasing hundreds of tons of physical gold, currently standing at well over 550 tons, when in reality, not a single ounce has left their site account. And we've been through this multiple times, drawing attention to the fact that nothing they have sold has hit the wholesale market. We would know about it. And that's at least 3 years. I think it's closer to 5, but well over 3 years. Every time we've seen any kind of selling coming on, it's been in unallocated form. And that tells us, what does that tell us? It means if you haven't got the physical to lease out on the expectation you'll get it back, well, what are you going to do? Well, basically, you're going to rely on paper. And so really this US dollar price suppression scheme, it shows it's running on fumes. Otherwise, if you had the physical and you thought you could get it back, you would simply lease it out, which is what used to happen. And aside from what we're seeing on the wholesale markets, this condition is also evident in the futures market structure. Now, futures markets, of course, are the primary hedging venues for both physical and the much larger over-the-counter unallocated long positions, where I think we had well over 800,000 contracts peak out in COMEX Gold. We're talking about the open interest, we're talking about the number of positions that have been taken, short-long positions, and that peaked out at 800,000 back in January 2020. Now, since then, we've witnessed these officials and agent insiders exiting their short positions into a rising gold price. So think about this. We've seen a reduction of over 320,000 lots into a rising gold price. That's 1,000 tons of physical gold, equating to 1,000 tons of physical gold. Of course, there's no physical involved here. So, but think about that. That is, it's so obvious when you look at the condition. How can the price rise and the open interest drop? So it tells us something. Now, notably, even though open interest has risen a little into the current price rise, it's fallen to its lowest level since, I think, May 2019. But you know what? Gold was trading $500 lower at that point. So in the 1270s.
Well, Andy, I'll tell you, there's a lot of people that are asking also, they see what's happening with even with this Basell III coming on, they're kind of getting a feel for it, but a lot of people are asking if you could comment or maybe spend a little time looking at maybe the shorter term action or what the possibilities are in the shorter term.
Yeah, no, that's a really good idea. I do get an awful lot of questions around this, especially as action has been so counterintuitive, but kind of drilling down into the immediate action, which is kind of what people want to know. And we'll go back to where last week, so this is since our last episode. So last week, we anticipated a bullish move, and we got it. And really, it was the first, if you think about it, last week was actually the first full week of April gold and silver trading, because the previous 2 weeks had been holiday shortened either by the UK or the US. So that's really when we see the trading, you know, more of a normal full liquidity trading venue. So basically, so we see this new first week of trading was 100% driven by the reported large spot index buying for T+2 physical delivery. And obviously we covered this a lot in previous episodes, but essentially what we're saying is if you go and buy, if you want to take physical delivery, you're not going to the COMEX. What you're doing, the COMEX may set the price, but then you go to the over-the-counter markets, you go to the fixes, or you can buy, or just lock in a price on the spot market and demand delivery. And according to the rules, you are getting delivery in T+2 days, meaning 2 days. Now, as we warned in our last 3 episodes, the very short-term effect of the BIS and the related insiders buying back unallocated gold positions, in other words, to get rid of an unallocated gold position, you have to actually square it up. And what does that mean? It means that you have to sell that unallocated gold position to buy back the dollar. This is a foreign exchange trade. There's a pair to every foreign exchange trade. So, you know, if you're long gold, you're short the dollar. And if you want to unwind an unallocated position, which is leveraged 100 to 1, well, you still got to unload that position and buy back the dollar. So what is the immediate effect of that? The immediate effect of that, it creates very short-term volatility. And what we're seeing is position squaring, though, and that's a process that is actually bullish. Now, I see this action as wrong footing an awful lot of pure technical traders who really have no view into the changing, ever more physical structure of the gold and silver markets. And you can't blame them because it's a 50-year history. In other words, you can take a trend line that goes back 10 years, 20 years. You can take a trend line that's going back even just 2 or 3 years and say, well, this is probably an area I should buy or sell. But I mean, you've got a changing marketplace. You've got a changing structure. So there's a lot of wrong footing going on. When you see something suddenly drop, you think, oh, well, everyone's dumping. No, they're not. They're squaring up an unallocated position. So on the face of it, when we evidence this downside action, naturally it looks bearish. But as we warned last time, tracking short open interest on the COMEX without, as best as possible, weighing it against what we can best assess being sought for this T+2 delivery on the spot market, it provides a completely distorted picture. And a good example really is the published COT report, which is obviously, we've discussed how that's deliberately withheld from being published. I mean, goodness me, I mean, that data is available at the end of each day. And then it's withheld for 3 days. I mean, it's little more than a tool to try and wrong foot as many COMEX non-delivery siloed participants as possible. And what this report fails to factor in is that the 10 times larger legs of transaction, the other side of this leg of the COMEX is an over-the-counter transaction, which is 10 times larger. And as we can see by people are looking at the most recent report and saying, oh my goodness, you know, it looks a bit bearish to me. But bear in mind, I mean, really, this supposed counterintuitive action that is being painted into the COT report, it's what's not factored in is that until these spot index T+2 deliveries are delivered, they then overrun the COMEX sellers, and right on cue, what did it do? It forced them to cover this week. And that's what we anticipated would happen. Now, currently, you know, the gold open interest, because again, we talked about that big reduction, these numbers actually include short hedges related to allocated bullion held legitimately by an increasing number of second tier banks seeking to comply with upcoming Basell III rules. Now, the open interest collapse only partly reflects the unwind of unallocated gold positions. Obviously, because you've got a legitimate, when you see a big short position appear in the COMEX, that can actually be because you're hedging a physical position. Now, I understand that game has been usually that when you see the open interest, you say this is a naked short. It has been, but there's a race to cover. So in silver, I mean, these reports also don't reflect the bullish physical and over-the-counter positioning. And so when you net everything out, is my point, the open interest structure of both reports are currently extremely bullish. So we must keep in mind that the sole reason for this lagging COMEX price, which is sincerely lagging fundamentals, and the structural effect is that when these long over-the-counter positions for delivery are hedged on the COMEX, it initially, as I say, looks bearish. As on the COMEX side of the trade, short interest looks to be rising. But the unwind process of unallocated contracts ultimately leads to a higher price in gold futures. And this is what we're currently evidencing. And we're seeing it this week. Now, last week's physically driven action, and we saw the rally commence last week, in gold futures and silver futures, of course, was led by the same actors in silver futures. Now, the action in the smaller silver market always provides us a clearer window. It kind of foreshadows what these same actors are up to in the much more opaque gold market. So early on, we'd noticed silver evidencing far stronger legs into a very lagging gold market, and it was telegraphing that gold futures were beginning to coil for a stronger move higher. And this was better evident last Friday morning when a stronger dollar index and rising bond yields, which is a toxic cocktail, usually driving gold down. And although it had the usual plain vanilla algo selling these crosses, but with both gold and silver grossly underpriced in the physical markets, this was offsetting automated bearish technical algorithm selling action. So these are the clues we look for, because normally if it was just a paper market, pure paper market, who cares? Now, so medium and long term, we, along with every bullion desk we're speaking to, are extremely bullish for physical gold and silver and hold all our core and medium term positions, ourselves, our clients, long and strong. And so basically looking at the very, very short term, I mean, really very little has changed in the gold futures options structure, which is another question I get. Well, where is the kind of the sweet spots? Where do these guys, where do the big players, the market makers, where do they want the price to be? So we noted a couple of weeks ago, there was very strong option support at 1750 in gold. Now that never wavered into all the insider. I mean, look, insiders are not short selling. They're bid pulling. The power of collusion. In other words, the power of position concentration. If you hold the largest position, or you and a group of market makers hold a very large position concentration, all you need to do as a market maker is start to agree to pull some bids. You can crash a price. However, what are they using these dips for? To buy back. So really, so we're seeing 1750 support. They didn't want to get below that. And very little has changed, really. We still see 1800 as looking magnetic. In fact, further out, it looks like 1900 resistance is beginning to lighten up just on the footprints. And as we noted last time, we see both gold and silver as having once again stair-stepped higher. And so in gold, we see the bounce on, there's a rising trend line from May 2019, and it cuts through the March 20 EFP blow up point, and we saw a lovely bounce on that at 1680. That was as low as you're going to get, and we saw that, and since then the price has risen rapidly as everyone raced to buy back positions and also to short cover. And so it's looking really bullish. Even short term, it's looking bullish. And we see dips being utilized by insiders as short covering opportunities to assist in the unwinding of these unallocated contracts. So again, we're talking about an unusual circumstance. And if we look very short term, obviously silver is close to our heart, because silver is going to be the rocket ship here. The massive spot index buying we've been evidencing in spot silver it's been huge. It's driving the current rally off the end of March 23.7 lows. I remember this was such a counterintuitive. It was conducted through bid pulling, wrong footing the technical sellers, and so really we noted strong insider buying occurring. I think last time we talked about 25. It can't live below 25. It cannot exist below 25. And the OPEC structure once again confirms that the silver options expectations are far closer now to 32.50 at this point. And I'm not saying tomorrow, but what I'm saying is further out that structure looks magnetic. And silver 25, absolutely strong. So also, if you think about it, 32.50 would confluence exactly with a gap close from the October 2012 sell-off, and that where silver has not actually closed that gap yet. Gaps get closed, up or down.
That's amazing. Thanks for that update. Now, here we are heading down the home stretch of April, here heading into May. What are you seeing further out this year, towards the end of the year?
Yeah, no, that's the other question, of course, is of course, there's various, if you're a stacker, hey, it's not a problem. You just keep stacking and stacking. And I think that's a really smart way to do it, because what you're looking at, you're not caring about a chart. You're not looking at a 10-minute chart. You're not even looking at a daily chart. You're just saying, you know what? I need to swap my rapidly depreciating dollars, pounds, euros, yen, whatever it might be. I'd like to swap some of that for something physical that's going to endure. And so really, so that it doesn't so much affect the stackers, but really people want to know what we're seeing further out. And so what, in other words, what's coming down the pike. But what we see is there are two major drivers, and this is other than and in conjunction with Basel III, but these are big drivers and they're fresh. First one is China. The second one is the UAE moving to compete with the LBMA. And let's just start with the UAE. In our December episode of Live from the Vault, we actually drew attention to an aggressive attempt by the LBMA to ring fence the global physical markets. And if you recall, this was a desperation measure. After discussions with industry insiders, we assessed that this effect, and we'll look at what they did, if you remind you what they did in a second, but we said that this aggressive attempt to ring fence the physical market after the EFP blow up, that would backfire on them. And we gave it 3 to 6 months. Well, it just has. And so basically what we're saying is bang in the middle of the 3 to 6 month time frame that really we all assessed with our industry colleagues, the pushback against the LBMA finally commenced actually last Thursday or Friday, I think it was. And this was in retaliation against the letter that the LBMA sent out to all the major global hubs and refineries late November, threatening to cut off accreditations within 30 days if the LBMA's terms were not agreed to in writing. In other words, you're cut off. Now, we highlighted back in December, this was very ill-advised, and this threat, when you think about who this threat was made against, it was every single physical trading hub: China, Hong Kong, India, Japan, Russia, Singapore, South Africa, Switzerland, Turkey, the UAE, United Kingdom, the US. Every single refinery was warned that unless they complied to strictly enforced LBMA standards, these refineries would be cut off from being loco London tradable. Now, as we noted at the time, this aggressive move to ring fence the 15 trillion a year gold credit trade, because when we look at the over-the-counter market and it's 100 to 1, we're looking at a gold credit trade, not a physical gold trade, that was instigated in defense of this fractionally held working stock being targeted for physical delivery following the EFP blow-up in March 2020. So if you take physical each ounce of physical you take out of the market, you suddenly have 100 ounces hanging out there. So the LBMA and CME joint effort, it was a joint effort from them. It was an attempt to halt the erosion of their monopolistic hold over the global physical markets. And this is being attempted under the guise of establishing a globally accepted standard under their control. However, this so-called standard comes from an organization that has harbored proven bad actors and worse, and this to me beggars belief, including the anchor LBMA market maker JP Morgan, already labeled a criminal organization by the Department of Justice before this letter was sent out. And the fact that they're trying to defend price discovery mechanisms that really in no way represent what the industry wants, which basically all the industry wants is a stable, fair price based upon real supply-demand fundamentals. That is the equation everybody wants. And as anticipated, this aggressive attempt to ring-fence the cartel's game is now backfiring. And based upon the reaction this week from meetings we've had with industry insiders, this move has accelerated the path to the cartel's demise as price setters. Now, the fallout amongst the industry titans such as Russia and China and the UAE specifically has wide implications for the LBMA and the COMEX. I mean, the house is completely reliant on operating within a fractionally held working stock environment where physical deliveries represent little more than electronically matched deallocated gold and silver positions, which are settled by netting out gold credits amongst their members on a daily basis. And we notice this, 8,000 tons of netted out positions versus maybe 3 to 5 tons of actual physical. So a ludicrous situation, which is what Basell III is going to address. Now, it's precisely this ring-fenced activity that has enabled gold and price discovery to be controlled by the 10 times larger unallocated over-the-counter market, which is, of course, directly related to gold futures. So it is this directly related price-setting COMEX leg of the transaction that is setting the price of deliverable gold in the global markets that is under attack. And that's what this aggressive move was attempting to defend. But as we forewarned, in response to this strong arm tactic, we have Russia, India, the UAE have moved to create a globally accepted UAE standard that ultimately seeks LME accreditations. To me, this is the perfect vehicle for the LME to progress its plans to compete with the LBMA. This is a rival organization that has a physical gold contract that is too small to trade at this point, but requires its own brand. And with a physically settled global accepted 4/9 non-LBMA standard bar for physical contract, then obviously you are in the game. And if you recall, and it will be an accepted contract. And if you recall, we raised this discussion back in September, naming Goldman Sachs and ICBC, as well as ICE, the exchange, have been working on such a venture since September of last year. And when the LBMA this kind of came into being after the LBMA first foreshadowed its plans to usurp the refinery industry under its own brand. So if that's not enough to put the LBMA on its heels, by no coincidence, China jumped into the fray on exactly the same day as the UAE announced its intentions.
Now, Andy, just a few editions ago, you had mentioned China. And maybe for those that didn't hear it, maybe you can just touch on what's happening, because this seems very important. Can you just share with the viewers what's happening and what this means as China just made this announcement?
Yeah, this is huge. This is absolutely huge. And again, this is another game changer. It's easy to say the word game changer. It is a game changer. On last Friday, on the heels of confirmation India had been accumulating very large imports of gold. And if you remember, we kept saying India is a buyer, and the reports out there were saying they're not a buyer. They were indeed a buyer, and now it's proven. But right on the heels of that, China now has moved to step up imports. Now, the announcement that China made is undoubtedly a pushback and a shot across the bows of the US financial system. Now, rumors were that we were hearing about China opening up imports of gold just suddenly went public. And this will indeed put a floor under gold, but also removes the agreed price cap, which obviously China didn't want the price of gold to be rapidly appreciating. But considering the June 28th Basel III NSFR deadline is fast approaching, this move by China to raise the cap on physical gold imports into the Chinese mainland will undoubtedly incentivize investors, insiders, central banks to accelerate the process of ditching underpriced, unallocated US dollar price gold positions into an ever dwindling supply of physical gold, which is shortly to benefit from a 0% risk weighting. I mean, come on, this is a no-brainer. The gauntlet has been thrown and the race is now on. And as of this morning, Swiss refiners, as of today, we're recording this on Thursday, Swiss refiners are sold out. Now recall the last time the Swiss refiners were sold out. It was the trigger to the March 2020 EFP blowout, triggering, and if you remember, that triggered a $650 gold price rise and an $18 price rise in silver. So really, insiders are busy trying to ditch unallocated contracts. Need this? They need this like a hole in the head right now. And under Basel III regulations, every central bank will be able to revalue its physical reserves higher from this 50% haircut into a fully cash exchangeable asset. Now, central banks will be able to pay off massive swathes of debt by revaluing gold. Now, not just from a cash asset perspective, but also it would behove central banks to be on the long side of gold ahead of this revaluation, naturally. Now, this is undoubtedly China and Russia breaking rank from an agreement to keep the price of gold contained. Period. The attack on US dollar hegemony moves now center stage, and a gold price revaluation is the freshly launched missile. And really, there's no other way to explain this. Why would you do that? Why would you take that cap off? Why would you suddenly allow all these imports? And this goes on the back of lots of other information, Russia dumping the dollar to buy gold, etc., etc. But for those holding physical assets, really, the timing really could not be better. I mean, whether it's gold or silver, silver is going to benefit just as much. So, but at best assessment, we still see, and we've said this for a long time, we still see 2,500 gold as the trigger point for that gold price revaluation. And as we reported as far back as January, when Basel III and we talked about Basel IV NSFR regulations came onto the front burner, this was the reason we evidenced trading and bullion banks ditching the most profitable part of their business, which was the third-party custody business. And that included the likes of, if you remember, Scotiabank, as well as first-tier LBMA banks with footprints, especially with footprints in Europe, where the frantically lobbied 6-month LBMA extension for the UK to comply will actually not apply. So in other words, the LBMA has sought to buy some time, by 6 more months. But obviously, wherever the footprints are, the jurisdictions are in the compliant zones. So it has to apply. So it will not be long, though, before global central banks, and this is, I think, where we're headed with this, particularly China and Russia, it won't be long before they reveal just how much physical gold backs up their respective currencies. This is the Trump card. And this is a massive pushback against Biden's win-lose geopolitical ambitions. And you know, really, I mean, let's face it, you're poking some very powerful enemies here. And it seems implausible that this is not, I mean, this is not well thought through. And we see this as really a strategic move by China and Russia to allow a gold price revaluation as very well timed. You don't need missiles to actually win a war. And the United States relies on the dollar's special status of its exorbitant privilege to fund massive private borrowing. And we now see the US on the back foot, unless they also move to front run an upside sanctioned US dollar gold price revaluation. This has got to happen. And if we look, we kind of looked at the revaluation metrics briefly last time. You know, these questions have been raised about the integrity. What is this 8,130 tons of officially held US gold? What's the integrity of it? I mean, let's remember that tiny 300-ton request, German repatriation request in 2013. Remember what happened? They wanted 7 years to deliver it. I mean, look, okay, it happened in 3. Even so, it could have happened in a week. But this obviously raises the question of how much of these reported US dollar holdings are actually rehypothecated. Look, these concerns have not gone away. A lot of faith has been lost, and we see a lot of countries repatriating, busy repatriating. So we've been looking at the trigger point for China to disclose its estimated 25,000 tons of gold. Most people are saying somewhere between 20 and 25. I really do think it's at least 25,000 tons of gold. And it's no coincidence that China's President Xi Jinping walks around with a copy of Sun Tzu, The Art of War, in his pocket. Now, why do you think he does that? Openly. An untimely gold price revaluation will be the ultimate and winning art of war. So our footprints in the 10 times larger spot gold market, as well as clues coming from open interest reductions in the casino, what they do is they point to insiders betting on a higher physical gold price. I say shots are fired. The game is on, guys. My only question to everyone is, have you got enough physical gold or silver? I mean, the global race to accumulate is on. Now, it doesn't matter where you get your gold and silver, and I certainly think silver is the Achilles heel. Look, you can buy it you can buy KAG in Kinesis. You can go anywhere in the world and ask for silver. Do it. I understand that. I mean, and I'm going off the back here of, I think, Craig, our dear friend Craig Hemke, who was with us, I think about a month ago on Live from the Vault, and Chris Marcus of Arcadia are trying to draw, I think, 100,000 people. I think I read it the other day, 100,000 people to buy 100 ounces each. Do it, guys. Come and do it with us. Do it with them. Do it everywhere. Just get your silver. This is the Achilles heel. So I would strongly suggest, I think they want to do it on the 1st of May. Well, do it. I really suggest you do. And that's not trading advice. That's simply saying, look, let's be part of this movement. Let's be part of the solution. And physical, by adding this pressure to what we've just described as a massive pressure valve about to go off. This is not a good time for the cartel. And by moving now, really, I think you're going to really cause a massive issue in the silver market. And if you can break the silver market, you've broken the gold market.
Well, there you have it. A big push happening to buy both physical gold, physical silver. And so there you have it, everyone. Thank you so much, Andy, for that awesome and fascinating what's happening in this time in history in the precious metals. And that concludes another episode of Live from the Vault. And I want to make sure to reach out to everyone here in the community to be sure to spread the word about this channel. Hit the like button. Please share it with all your friends. And by clicking on that bell, I just want to remind you that if you click on the bell and you hit the all, you'll be notified immediately as these awesome episodes go live. So with that, thank you so much, Andy Maguire, talking gold over in the UK. Thank you so much. Bye for now.